of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Okay. Got several early risers today to join us, so thank you for all coming. Thank you for being here. We'll give Joe a second to get back to his seat, but I want to welcome today to join us here Emma Adlam from Baker Tilly, our financial advisor for the county. And we had tasked Emma and Baker Tilly with doing a preliminary review, a fiscal impact study to attempt to, as well as possible with the information known today, project what the impact of the recently enacted Senate Enrolled Act 1, what we've referred to as Senate Bill 1, the financial impact that may have on the county. So that was going to require a lot more detail and data than we had the ability as a council to do ourselves, and so we engaged Baker Tilly to do that study, and Emma has, I think what's fair to say is the preliminary report. We're going to get some more parcel level, really detailed data within a short time, but I think we can get a pretty good view of where we stand now with the higher level data. So I'm going to turn the floor over to Emma, and she can walk through her presentation.
Good morning, everyone.
Good morning.
Good morning. Bright and early.
Yes.
Excuse me. As Alan said, I put together a presentation that I don't know. Do you see it on your screens too, or do you have to?
Can we pull that up somehow? Do we have any way to get that? No. Okay.
All right. Well,
So
apologies.
you'll have to turn around and watch the screens behind you.
So I put together a presentation that it starts with a summary of the legislative impacts, and then it goes into looking at two different models of the direct impact to Clinton County. But this past legislative session was fairly active with impacts to local governments. So I'm first going to talk about there's two main areas where I'll probably say Senate Bill 1, and I'll probably also say SEA 1. Those are the same bills. It was Senate Bill before the legislation was enacted. So there are two main impacts for SEA 1. One is on property taxes, the other is income taxes. So those are, of course, the two main revenue sources for the county. And so I'm going to get into a lot of detail, but just to kind of highlight, set the stage for the next several slides. Senate Bill 1, it increased automatic deductions for different property classifications. It increased the de minimis exemption for business personal property. It changed the calculation methodology for agricultural base rate. It eliminated something called the property tax relief of local income tax, which impacts your tax bills. For budgeting, as a constraint that you're going to be operating with now, it limited the maximum levy growth quotient in 2026. And then it also changed the local income tax structure beginning in 2028. So this slide and the next slide, there's several years, it's about 6 years that these changes are going to be phased in. And so you don't have to read every single line here, but this just is a useful resource for you of what happens in what year. So you can try to piece, okay, what are we focusing on this year? What's going to happen next year? So right now in 2025, as you're working on your budget for next year, that maximum levy growth quotient is capped at 4%. And the other piece is that there are new controlled project thresholds that were effective starting in July. Taxes payable 26 is when a lot of the real changes really kick in. And you're about to get your 2026 certified net assessed values, but in those, the new deductions that I'll be covering, they are starting to be phased in. And then 2027 is when that business personal property begins, the change of the de minimis. So to start with the change in the homestead property deductions, that in 2025, I'm going to start on the left-hand side. So in 2025, there are two deductions applied to homestead properties. And so this is when you get your gross assessed value from the assessor. That is the total assessed value of your property. And then there are deductions that decrease your assessed value to get to the net assessed value that you're taxed on. And currently in 2025, there is something called a standard deduction of $48,000 and a supplemental homestead deduction of 37.5% of the net assessed value. The standard deduction, if you look from 26 to 2031, the standard deduction is being phased out. So in 26, it's still 48,000, but then by 2031, it becomes zero. The supplemental homestead deduction is going to steadily increase up to 66.7% by 2031. So if you think about your gross assessed value for a homestead property, basically by 2031, 2/3 of your assessed value will be deducted and from what your tax base is. There are new credits applied to homestead properties. The first new credit is the supplemental homestead credit, and that is the lesser of $300 or 10% of the net property tax bill. There's also a 65 and over credit and a disabled homeowner credit. Those used to be deductions. So they used to be dollars that were taken out of the net assessed value if you qualified. That now credits are deductions to the actual tax bill. So after your tax bill is calculated, after you have circuit breaker credits applied, local income tax credits applied, then these new credits are applied from your tax bill. So they come out at different points as opposed to deductions. They're now taken out at the end as credits.
Emma, can I interrupt? I just want to say,
Yes.
This morning, Emma did send me an electronic copy of this, and I'll provide it to all the council and to the department heads.
Sorry, that's true. I see
So
you
I
taking
should have said that
furious
before,
notes.
but everybody will get a copy of this.
Yes.
So.
Thank you, Alan. And please, stop me if you have questions along the way. I don't need to just talk straight for 20 minutes. So if you have questions, and if something isn't clear, please ask as I'm going through this. So just to take a look at what do these new deductions mean to the net assessed value? This is just an illustrative home value, which is the average home value in Indiana, that is about $241,000. That with today's deductions, the net assessed value, or that taxable value, decreases to about $120,446. With the new deductions added in, it goes down to about $80,000. I know there's the giant caveat of, well, property values do increase over time, and it's not going to be just $240,000, but just to help you get a sense of the impact of just the deductions alone. Moving on to 2% properties. So 2% properties are non-homestead residential. So if it's a property that has it's a second home, or if it's a rental property, long-term care facilities, agricultural properties. These count as 2% properties. And these properties, sometimes they can have an abatement, like an apartment occasionally will have an abatement, but typically there are not deductions on 2% properties. They are now going to have automatic deductions applied to their gross assessed value. Starting in 26, it's 6%, all the way up to 33.4% by 2031. So just thinking about of all the 2% property in Clinton County, by 2031, it'll have a 1/3 decrease in the net assessed value.
So the net result of all this is a shrinking tax base.
Exactly. Business personal property is another piece that will impact the tax base. That currently there is something called a de minimis exemption. That if a company's business personal property is $80,000 or less, it's exempt from taxation. And this de minimis is increasing from $80,000 to $2 million. So not payable 26, but in payable 27, this exemption starts. And that there is another new piece that as a company replaces its existing equipment, that new equipment placed in service after January 1, 2025 no longer is subject to something called the floor. That in Indiana, business personal property there are depreciation schedules. Depending on the useful life of the property, it can be depreciated all the way down to potentially 5%, depending on the useful life. Currently, there is a minimum value of 30%, that even though the depreciation might go below 30%, there's a 30% minimum. New equipment placed in service after January 1, 25, that 30% floor will be eliminated, so it can be depreciated below that amount. With an exception if it's a piece of personal property located within an existing TIF area. All right, what does that mean for your existing tax base? You know, if you're thinking about changes in 1% property, changes in 2% property, changes in business personal property. Starting with the more colorful chart on the left, this is based on your 2025 assessed values. This is the composition of your assessed values. That the green color is the 27% is the 1% homesteads, 2% is the rental, residential, agricultural, long-term care. 3% is the blue, that's 16%, and business personal property is 19%. Take that 19% business personal property and you want to know how much we're estimating it to be part of that new de minimis $2 million amount. That's that pie chart on the right where we're thinking about 21% of that 19% will potentially be eliminated because we're estimating it to be part of the new de minimis value. Any questions on this piece or anything I've covered so far?
Can you make that very last statement again?
So the de minimis personal property, where if the acquisition cost is $2 million or less, we're assuming of your pie of business personal property, about 21% of the business personal property falls under that new exemption, so would be taken out of the tax.
It would go away. Yeah.
Thank you.
Another piece impacting levies and tax rates for all communities is this maximum levy growth quotient, which I mentioned earlier, but I want to touch on a little bit more. That as I know as a council, you're well aware that the majority of your funds are subject to levy limitations, that you have a maximum levy that you're allowed to levy, and that each year there is a formula for how much that levy can increase. And that based on the formula for 26, it was going to be about 5.6%, but the legislature capped it at 4%. So instead of your levy growing by 5.6, it can only grow by 4%. They did something similar for 2025, that there was a 4% cap on your maximum levy in 2025. And that currently in legislation, the maximum levy is going to revert to the current formula after 2026. You don't have to worry about the last bullet point until 2029 for budget year 2030, but if you want to increase your levy for 2030 from your 2029 level, there is an additional ordinance public hearing that you have to follow, but that's not for a couple of years. So now I want to kind of talk about, we have changes in assessed value. How does that impact tax rates, circuit breaker? How does the income tax piece change? How does that impact your taxes? So circuit breaker credits. This is a confusing concept, so please ask me if things don't make sense to you, but depending on the type of property, you are capped at what your tax bill can be. And that if your computed property bill is over this cap, then those taxes are not paid. And so that loss is distributed amongst the various taxing districts, so the county, city, township. And so these are called circuit breaker credits or circuit breaker losses because it's a credit or a reduction in the tax bill. So residential properties are capped at 1%, 2% or other residential, agriculture, long-term care facilities capped at 2%. Commercial, industrial, both real and personal have a 3% tax cap. And I'm going to add a note at the bottom that if it is a tax rate that was approved through voter referendum, that is outside of the tax cap. So Frankfurt Schools has a referendum rate in place, so those caps are actually a little bit over these stated amounts because of those referendum rates. So what does a sample property tax bill look like? Just to kind of try to put the credits, you know, sometimes I'm a visual person, sometimes I like to see numbers. So if you have a 2% residential property, like think of an apartment building, that tax cap is 2%, so it'd be $10,000. Currently, there are no deductions, and so with a just under $4 tax rate, that tax bill would be almost $20,000, but because of that tax cap, there is almost $10,000 of circuit breaker credits generated on this parcel. So this parcel just does not pay $9,958, and that loss is allocated to all the overlapping taxing districts. So if you're thinking about, okay, if there's downward pressure in net assessed value, there's an inverse relationship in net assessed value and tax rate. So if your net assessed value has downward pressure, there's upward pressure on tax rates. If this property is at the tax cap and there's upward pressure in tax rates, that would just generate an increase in circuit breaker losses. It does not actually generate increased taxes that the taxpayer is paying. Now, there's a piece to the circuit breaker calculation called property tax replacement credit. So currently Clinton County has a 0.5% income tax dedicated towards property tax relief. And this is a credit that appears on property tax bills that reduces the gross tax bill that a property owner has to pay. And so therefore it reduces the circuit breaker credits, which I'll show an example on the next slide. That currently of the 0.5%, the county has separated into being applied to reduce different types of property bills. So the 1% property tax cap, the income tax pays 3.0267%, very specific, of that tax bill. For properties assessed at the 2% tax cap, it's 11.2135% of the tax bill is paid from income taxes, and then residential properties, it's an additional 23.7768%. These credits expire following 2027. So what do all those mean from this example apartment that I just showed? So we have on the left-hand side that without property tax replacement credit, so that almost $10,000 circuit breaker losses. That same parcel on the right-hand side, based on the current allocation of property tax replacement credit, almost $7,000 of this tax bill is paid from income taxes currently. And so the net tax bill is brought down to just under $13,000. So the circuit breaker credits are actually only $2,975 instead of $9,958. So you can see the impact of the income tax paying a portion of this tax bill, and that is reducing the amount of circuit breaker credits that are distributed to the overlapping taxing units. Any questions on the concept of circuit breaker or property tax replacement credits?
Makes sense.
So I'm going to move into the two different models and looking at what this means for Clinton County. Their first model was prepared by Legislative Services Agency, or LSA, that was prepared right when Senate Bill 1 was passed. And so they use the best data they have at the time. So they built in the de minimis exemption that was in place when Senate Bill 1 was passed. It was slightly modified a week later by House Enrolled Act 1427. The only difference was the year the de minimis comes into play. They included the new homestead deductions, the new 2% deductions, the new homestead credits. They assumed that the maximum levy growth reverts back to the formula in 27 and 28, and they accounted for the expiration of the property tax relief lit in 2027. So this, excuse me, This is a chart version of LSA's data, where each column represents the gross levy for the county. And we have 22 through 25 actual, 26 through 28 is estimated. So if you look at 22 through 25, your gross levy is the full column, but you lose a little bit each year in circuit breaker credits. And so that's the gray top piece of each column. And so purple is the net levy, or the actual dollars that the county received. And so LSA looked at 26, 27, 28, where purple is their estimated net levy, so how much you're estimated to receive. And then the blue is the estimated reduction from pre-Senate Enrolled Act 1 net levy. So without SEA 1, it would be, the purple would be the blue and the purple combined. So it's still showing an increase in levy. It's just not as big of an increase as you would have received without the new legislation. So we looked at the same information, but in a longer time frame, because as you see, LSA's data ends in 2028, but these deductions are phased in through 2031. So what does that mean for Clinton County going forward? As Alan alluded to, we're working on an in-depth parcel level analysis for you all, because all of these credits are really determined per parcel. You know, what taxing district do you sit in? Are you 1% property, 2% property? Do you have 1 and 2% on the same property? So while we're still working on that, because it's very complicated, this is a higher level look, making some more general assumptions. So don't take these numbers as specific numbers. It's more showing you the directional impact. That we made a lot of similar assumptions. We made assumptions for the new deductions being built in, the de minimis change in business personal property, the expiration of the property tax replacement credit. One difference from LSA's model is that we assume the maximum levy growth factor would continue to be capped at 4%. Just to be conservative, and that there is history of the General Assembly capping the maximum levy. They did it last year, they're doing it this year. Potentially, they will continue to cap it going forward. And then we allocated circuit breaker credits going forward based on the current allocation in 2025. We did account for the expiration of, you have a general obligation bond that expires beginning taxes payable 27. We did factor in the decrease in the tax rate from that bond being paid off. And so from all of these changes, this chart shows historical and illustrative net assessed values. So 22 through 25 is historical, 26 through 31 is our estimated looking forward. So there's some decreases in 26 and 27, you know, as these deductions are really phased in, and then we are assuming a little bit of growth going forward. I will say an important point is we assumed a 6.5% annual real property growth factor based on historical county-wide averages. So that's just all kind of across the board growth increase. So we are showing a little bit increase in your net assessed value, but while we're assuming a 6.5% increase in your gross assessed values, there are all these new deductions being applied, so that somewhat offsets the growth that you would have seen. So with that, slightly decreasing net assessed value, we're assuming stagnant, a little bit increased tax rates for the county tax rate, holding everything else constant. The reason that 26 and 27 look very similar is really because that general obligation bond levy would be paid off, and we're not showing it being replaced. And then after that, there's some upward pressure from the new deductions compared to the levy growth that we're assuming. So what does this look like putting it all together? This is that same type of chart as we had for LSA, but it goes out through 2031. So we're showing 22 through 25 actual, and then 26 through 31, purple once again is the net levy, gray is the estimated circuit breaker credits, blue is the estimated supplemental homestead credit. So similar to LSA, we're not showing a decrease in your net levy. It's still a growth, it's just not as much of a growth as you would have had without these changes. So I'm almost done, I promise. So the last couple of slides I want to touch base on is the local income tax, because you can't talk about the change in your fiscal health without talking about.
Before you go to income tax,
Yeah.
can you go back to that last?
Yep.
So I'm surprised to see as you go right that circuit breaker loss does not get bigger as the property tax replacement credit is phased out, because you had showed how big of an impact that was on the tax bill.
So I think there's a couple of reasons for why that in that example tax bill, that's based on current, 2025 values, but that 2% property has deductions being phased in. So that as the deductions are being phased in, they
The
are,
The bill's coming down.
yes, their tax bill is coming down because of those deductions.
Okay, that
So
makes
they're
sense.
they're slightly offset from one another.
Okay.
So to set the stage for what the changes are for local income tax, this is the current local income tax structure. There are a lot of different buckets, and so there's a lot going on this slide, but I'm going to start from the top and work down. So on the on the left, there is a bucket called property tax relief, that the maximum allowed is 1.25. Clinton County currently has a 0.5% income tax dedicated towards property tax relief. The middle group is called the expenditure rate, and within the expenditure rate, there are 6 different sub buckets within the expenditure rate. The maximum amount is 2.5%. And of that expenditure rate, you have 1% dedicated to certified shares, which is, think about general county services, 0.5% for public safety, 0.25 for economic development, 0.2 for correctional and rehabilitation facilities, 0.2 for EMS. And then you can see at the very bottom what your estimated 2026 distributions are for each of these different buckets. This whole structure is basically eliminated after 2027, and the whole structure will change to this new structure, that the county can adopt up to 1.2% for general county services. And unlike certified shares, where there's a 0.1% tax currently, but that's distributed not just to the county, but that 0.1% is distributed to cities and towns as well. So the new 1.2% would be kept by the county for county services. 0.4% for fire protection and EMS services that would be allocated to municipal fire departments, volunteer fire departments, fire territories, fire districts. Up to 0.2% for non-municipal units like townships and libraries. Up to 1.2% for municipalities of 3,500 or less, and that these top 4 are adopted by the county council. The non-municipal units and the smaller towns, those are upon petition from them, but it's the county council that actually make that adoption. And then larger municipalities greater than 3,500 population adopt their own municipal lit of 1.2%. So what does this look like in estimating revenues for Clinton County? On the left is blue. This is adding all of those different buckets together for 25 and 26. So in 26, adding up all those buckets, the DLGF's estimate is about 9.6 million. From estimate to certified, unless a rate changes, I really don't expect this 9.6 number to change. So next year, you'll get about 9.6 million. And then I showed illustrative different income tax rates up to that maximum 1.2% for the county services lit. So I show 0.5% would generate about 4.4 million, 1% about 8.8 million, 1.2% about 10.6 million. So compared to other units, you at least can replace the revenue that you're losing, which certain municipalities with their 1.2% municipal lit, they quite possibly cannot replace their lost revenue. So at least the 2026 lit number is less than the 1.2% estimate. So you most likely, unless something drastic happens to the adjusted gross income in Allen County, you can probably replace the revenue that you're losing and possibly even gain a little bit. And that is my last slide, so I'm happy to answer any questions.
Save the best for last.
I gotta end on a slightly positive note.
I'm really surprised to see that net levy was
Yeah.
still continuing to rise even a little bit going out. That surprises me.
I think it's because not all of Clinton County is at the tax caps. So while, yes, the city of Frankfort taxing district has a high tax rate, some of your other, townships and other parts have such a low tax rate. I think that helps. I think that we were showing historically, you have, I think I said like over 6% growth in assessed value, but only a 4% in levy. So as your assessed value, is increasing a little bit more than your levy, that slightly offsets those changes. But until we look at the actual parcel level estimates, it's a little hard to say specifically.
If you'd go back to that last slide on the income tax numbers, the 2026 lit revenues, that number would include our current EMS lit.
Yes.
And this number on the 1.2%, we could do an additional amount beyond that for EMS, correct? Under
There
the new
is
structure?
There is some uncertainty of that EMS, that fire EMS rate, if counties could keep a portion of it. Based on the wording in the current lit statute, it's unclear if counties could keep a portion of that 0.4%.
Well, if it says EMS and the county provides the EMS service, they would have to be able to keep a portion of it, would they not?
I'm just, just in talking with attorneys, it's a little, hopefully they'll clean it up in the next session. They're supposed to make some changes.
So that's something we need to provide feedback to legislators on.
Yes. Mm-hmm.
But that's why you chose to not show that as an additional source beyond that.
Exactly.
I got you.
Because it's to be conservative, and there's some question about, yes, it says fire or EMS, but there's some question of the way it's worded, if you could actually keep any of it.
Are you aware of any discussions at the state level about, and maybe Clinton County is very unique, I don't know, but we have an interlocal agreement to fund our central dispatch department using, with the city, the towns, and the county giving a portion of their public safety lit, all committing that to the joint funding of central dispatch. When that public safety lit goes away, was there any thought given or any discussion that you're aware of grandfathering those types of agreements or somehow keeping them in place so that we don't have to herd the cats again to?
I have not heard that. I will ask some of the other partners who work with other counties, but I haven't heard anything about grandfathering in agreements.
Okay. I'm concerned about that one.
I'll make a note to look into that just to see, but I haven't heard of it.
Okay. Other questions?
I have kind of a specific question. The CCRC, they put in a property, they're trying to get property taxes from CCRCs that are nonprofits. If they have
Can you
initial
define CCRC?
Yeah, I'm not familiar with that.
continuing care retirement community.
Okay.
So, they put in the legislature they want to collect property taxes, and it's a nonprofit,
Okay.
like we have Wesley Manor here. But Wesley Manor is part of a large group. There's like 12 properties around, and the people will pay. They're saying that the CCRC will pay property tax if they have an entrance fee of over $500,000.
Okay.
So then my question is, an entity like Wesley Manor is part of something bigger. So does the bigger have to pay property tax for all of their units around? Or
I don't know the answer to that, but I can add it to
I mean,
my.
that would make a difference in the property taxes in Clinton County.
So they're currently tax exempt?
Yes.
Okay. I don't know the answer to that question, but I can ask to see if I can find
It's
out.
just
for you.
interesting to see what that's gonna do. That's, if it's specific to the corporation that owns, you know, all the locations, or individually, they're looked at differently for property taxes.
Emma, one thing that I might want you to follow up and look at with those numbers as a baseline is I know that the county has an option to pass. There's a newer version. I don't think you had it on a slide, but my understanding is there's a newer version of that property tax replacement credit. There's a new option or a new.
It is
I think it maybe
for-
only applies to
for
the county rate.
homestead, for homestead properties, and it goes through 2027. So this new rate will expire while at the same time the.
Oh, okay.
It does not.
I thought it was to replace that one. that
It
was-
doesn't. It also
Okay.
has an expiration date.
Okay.
So that's why I didn't focus on it too much, because you already
'Cause
have
we already have the one. Okay.
income tax.
Okay. Clear as mud to everybody?
Thank you.
Okay. Like I said, Emma sent me that presentation this morning. I'll forward it to all of you so that you have that. I would print it out, stick it in your budget file, keep it as a handy reference because it'll certainly apply in the future budget years. But that was the first time we've been able to see numbers going out to that 2031 timeframe because LSA, as Emma had indicated, only had projected out to 2028. And I was really nervous about those
The next number.
those last 3 years. So I feel some sense of relief from the county perspective on how that all looks for us. Emma, thank you for making the drive.
Absolutely.
If there's no other questions, auditor office, anything? Feel good? Okay. All this gets to go to through your office
I
and for
know.
implementation. So want to make sure you're comfortable. All right. Well, we will-
Safe drive back.
we've got a few minutes. I had allowed this entire hour before the regular meeting to discuss this, but I'm going to take advantage of the few minutes, and I want to go over a couple of things, as big picture budget things, before we get into the departmental reviews. And just to kind of give us some parameters, we talked a little bit in this presentation about the growth quotient being capped at 4%. So what I did was if you take last year's property tax revenue and increase by 4%, we would have an additional $320,985. So let's call it $321,000 additional levy available to us. The increase in the certified shares, Emma mentioned that would be the $3 million number. It's $119,333 above the current year. So we have those two on the plus side as additional resources available. However, offsetting that, and working with Treasurer Gina Bretnacher, we're projecting a little bit here about the Fed is looking like they're going to begin reducing interest rates. That flows right through to what we get on our deposits. So we're expecting interest income to be down $300,000 for next year. So altogether, this is the first time we've had an interest income number go down in several years. But taken all together, that would leave us with a net of only an additional $140,300 of additional revenue beyond what we were getting in the current year. So that's the number against which we measure all of the additional increases to the spending side, which would include any potential raises, any just cost increases due to inflation for supplies and materials. And then the big one, I guess the one I want to give special note to is health insurance. That is the single biggest line item in the entire budget. And I've got, I don't have it handy. It's in my folder. I'll dig it out and I can pass it around. But for 2024, we have not received any renewal offers yet for our insurance plan. But what we do have is we get monthly performance updates that compare the claims paid out by the program versus the premiums we pay in. So for 2024, the full 12-month period, we paid out, or the insurance company paid out $3 million in claims, a little over $3 million in claims, while we only paid in $2.1 million in premium. So that does not work well for the insurance company, so they are going to ask for more money. For the first 5 months, which is the latest numbers that we have through May, we're running $455,000 the wrong way. So we're still on that track of about $1 million off. If you carry that through, that insurance company is very likely to come and say, hey, your premium needs to be $3 million, not $2.2 million. I'm expecting a very, very, very large increase in what that premium would be. Now, that's to keep the plan as it exists today. So there's nothing to say we can't change the plan to try to fit it into our budget. But I think that, if you say from 2 million to 3 million for easy numbers, that's a 50% increase. We have in our budget a projection for a 10% increase, because that's all I felt like we could possibly reasonably absorb into this budget. 10% on 2.2 million is 220,000, which has already used up everything that I said that we had as additional resources. So when this is all said and done, I think that I want to compliment the department heads. I thought they came with really good budgets. They were conservative budgets. They did exactly what we asked them to do. But we still may have some tough choices. So that's all independent of all of these impacts that we're talking about. This is just revenues and expenses and, where we look on trying to balance a budget. So we don't have to assume that we're going to, there are things we can do. We can change the plan design. We can increase deductibles. We can have a little bit less rich plan to try to get it down to fit into our budget. We can change the allocation of how much the county pays and what the employee pays. Our employees currently pay between 5 and 10%, depending on whether they're in the wellness program or not, because we give a credit for someone being involved in the wellness program. There are different types of plan offerings that we could even look at. There is an offering that would allow us to give a set amount of money to the employee, and the employee goes to the marketplace and buys their own insurance. So when we get those official numbers back on what the renewal will be, and we start to have the real scope of the problem, then we can start coming up with what those would be. But I think from our perspective, we need to be we need to adhere to that 10% level. Maybe we could find some money to reorganize and go to 12 or something like that, but we just don't have the resources to go much further than that. So as far as it fits into this budget, I think we need to stay pretty set with that 10% level for now.
When are you supposed to get numbers from the insurance?
So we have put it out for bid, so it's
Okay.
gone to the market. We expect to have numbers from Anthem. So remember, just to reset, Anthem bought IU health plans. So the health plan that we are on this year as an IU health plan will not exist after 12/31. So we're anticipating the renewal will come from Anthem, and last year's Anthem quote was plus 49%, looking at those numbers that we were just talking about. So I think we'll get the numbers from Anthem first, because they have access to all of our data. I'm not sure when we're going to get the renewals from the rest of the marketplace. So we're hoping to get United Healthcare, the other major players, that we'll get those. But the insurance committee is going to meet on the 26th, and we're hoping to have the numbers by then. I'm not sure we will. So it is possible, Todd, that we may not know the numbers before we would adopt in October, which is part of the reason that I say we better be comfortable with what we're willing to put in the budget, and then that puts the onus on the insurance committee to find a plan that works within that budget.
Wowza.
Yeah.
This is going to be a tough one.
Right.
So I just wanted to say all that at the front, because that's kind of the context within which we're going to review all of this. And I wanted, for the benefit of the department heads that may be here or watching online, to know the bigger picture outside of just their budgets as to what we're looking at overall.
And the county does not have, they're not partially self-insured, right?
No, we are fully insured.
Fully insured.
So, and the reason is that is exactly what's happening here in this last, say, 12 to 24 month period. So a fully insured policy means that you pay your premium, that's it, that's the only exposure you have. If you're partially self-insured, you pay your premium, and then you do have some exposure to those claims going up where you have to pay a portion of them. We have nearly half of the claims that we have out of that $3 million are from 12 individuals. So we have some high users that have medical conditions that are hitting the plan hard. We don't know because of HIPAA laws who those are, we have some general categories as to what those things might be, but whether those conditions continue on or will be resolved through a surgery or whatever, we don't really know. So our hope has been all along that we would see that this has been an unfortunate time period where we've had a bubble and that some of those things would get resolved and we go back down to where we had trended historically. But so far through 2025, we have not seen that reduction start yet, which is why I'm just, the insurance company's seeing the exact same thing and they're going to say, hey, until proven otherwise, we have to assume this is your new baseline and we're going to charge you accordingly. So we will keep you up to date as we learn those renewal numbers, but we don't have anything definite to work on yet. Okay, so we've got a little bit of time here. We'll take a short break, recess the budget hearing. We'll come back, have the regular meeting, and then start diving in after the regular meeting with the departmental budgets. Okay, so we'll reconvene at 9.
Man, so what is the health insurance committee doing? When I was on there, it was pretty boring.
Well, you know, it has been boring even through this most recent year.
We have no,
We're going to earn
we
our
have no
paycheck.